We begin with Chapter 10. In this chapter, we will analyze in detail the covered put strategy. The covered put position is used when the market outlook is neutral to slightly bearish. The strategy consists of selling, or having already shorted, 100 shares of the underlying stock and selling an out-of-the-money put option. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contract, and besides, the values do not include brokerage commissions. The maximum profit on this strategy is limited. The most we can make is equal to the stock price at trade initiation, that is, at the time of put sale, minus the strike price, plus the premium received, multiplied by the number of shares. On the other hand, the maximum loss that we are exposed to is unlimited, because the increase in the stock price has no limit. So be very careful with this, because with this strategy, we are exposed to a loss that can be very large. The break-even point is equal to the stock price at trade initiation plus the premium received. The break-even point defines the profit and loss zones. In our case, for stock prices lower than the break-even point, we are in a profitable situation. In contrast, for stock prices higher than the break-even point, we are in a losing situation. Continuing with the analysis, the initial margin required to open the position is equal to the 50% of the value of the shares sold short. The put sold is covered by the short shares. An increase in volatility hurts the position. Time decay helps the position. With respect to exit conditions, to fully close the position, we must buy the put and buy the shares. If the stock price is lower than the break-even point, we are in a profitable situation. Otherwise, we are in a losing situation. In the case that the stock is trading between the strike price and the selling price of the shares, the position can be partially closed by buying only the put sold. So we will make a profit from selling the put, and at the same time, we will hold the shares sold short. This will be analyzed next. When we open a covered put position, it is said that we are writing or selling a covered put. In this graph, we can see the influence of time decay on the position. On the vertical axis, profit and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. The blue curve indicates the profits and losses at the time of put sale. As we get closer to put expiration, the curve of profits and losses is like the one shown in green. And finally, at put expiration, the curve of profits and losses is the one shown in red. We can see that as time passes, the value of the break-even point increases. Notice how it moves to the right. And as the value of the break-even point increases, the range of prices for which we are in a profitable situation increases. Therefore, in this case, time decay helps the position. Now we will see in detail the exit conditions of the position at put expiration. Suppose we sell short 100 shares of Apple at $395, and at the same time we sell one put option with a strike price of $380 at a premium of $5.5. Notice that the put is out of the money, because its strike price is lower than the stock price. Therefore, the break-even point of the position is equal to the stock price at trade initiation plus the premium received. In our case, $395 plus 5.5, which is equal to $400.5. Here, in the graph, we indicate the strike price of the option, the initial stock price, and the break-even point. The strike price of the option is $380, the initial stock price is $395, and the break-even point is $400.5. Now, let's suppose that at put expiration, the stock price is $410, that is, higher than the break-even point. In that case, the premium received for selling the put is equal to 5.5 multiplied by 100, which is the price of a single contract, multiplied by 1, which is the number of contracts sold. That's a total of $550. On the other hand, as the price of $410 is higher than the initial price, we will be losing $1,500 for selling the shares, that is, from the short stock position. Therefore, although we received a total premium of $550, finally, we will be losing $950 due to the short stock position. Of course, as the stock price is higher than the break-even point, we are in a losing situation. In contrast, if at put expiration, the stock price is between the initial price and the break-even point, for example $398, in that case we will have the following. The premium received for selling the put is always $550. On the other hand, as the price of $398 is higher than the initial price, again, we will be losing for selling the shares. In this case, $300. However, despite this loss, as we received a total premium of $550, finally, we will be making $250. Of course, as the stock price is lower than the break-even point, we are in a profitable situation. On the other hand, if at put expiration the stock price is between the strike price of the option and the initial price, for example $385, in that case, we will have the following. The premium received is always $550. But in this case, as the price of $385 is lower than the initial price, we will be making money from the short stock position. In this case, we will be making $1,000. Therefore, we will be making a profit of $1,550 with this strategy, $1,000 for selling the shares, and $550 for selling the put. It is important to mention that as the option expired out of the money, we are not obligated to close the short stock position to cover the put. Thus, the premium received is an income for us, and if we want, we can hold the shares sold short. This is the best scenario for investors who use this strategy, because by selling the put, they are increasing cash income from the short stock position, and at the same time, they are not obligated to close it. Finally, if at put expiration, the stock price is lower than the strike price of the option, for example $370, in that case, we will have the following. The premium received is always $550. On the other hand, as the options sold will be expiring in the money, we will be obligated to buy the 100 shares at the strike price, that is, at $380. Thus, we will be making $1,500 from the short stock position. Therefore, we will be making a total profit of $2,050 with this strategy, $1,500 for selling the shares, and $550 for selling the put. Although we will be making the maximum potential profit for this strategy, we will lose the shares sold short because we will be obligated to buy them to cover the put. Let's see an example of how this strategy works. Here we are seeing the stock chart of the Amazon company. As we can see, on February 14, 2011, the company gave us a clear bearish signal because the stock touched resistance and was accompanied by a decline in volume and an RSI above 70%. As we said, on Monday, February 14, 2011, Amazon gave us a clear bearish signal. In order to take advantage of that, suppose at that time we had decided to sell short 200 shares of the company. At the close of that day, Amazon was trading at about $191, so the value of the short sale would have been $38,200. We must consider that an initial margin of $19,100 would have been required to open the position, that is, the 50% of the value of the short sale. A few days later, the stock started to fall until it reached the price of $169 on March 1st, touching the 1-month support. That can be seen here. We sold the shares on February 14, the day we got the bearish signal, and a few days later, the stock started to fall until it reached the price of $169 on March 1st, touching the 1-month support. A few days later, the stock was failing to break through support at $169, so it was expected to continue to trade between $175 and $165. To make a return on our short stock position, suppose at that time, with the stock trading at $169, we decided to place a covered put. As we had sold short 200 shares, we decided to sell 2 puts with a strike price of $165 and expiration in March 2011 at a premium of $3.2. Thus, we would have received $320 per contract, that is, $640 overall. With the 200 shares we had previously sold short, we would be covering the 2 contracts sold. Notice that the puts are out of the money because their strike price is lower than the current stock price. A few days later, on March 14, the stock was trading near $166.5. It is important to mention that the covered put strategy is used by investors who are bearish on the stock, but think that it may experience a slight rise or a period of quiet trading. Therefore, by selling put options, they are generating income from the options premium. It is recommended to sell the put options during falling trading days because on those days the premium is higher. As we had said, on March 14, a few days after selling the options, the stock was trading near $166.5. At that time, the puts were trading at a premium of $1.6. The options were expiring in 4 days. If we had bought the contracts at that time, we would have locked in half of the premium received, that is, $320. In addition, we would have made a profit of $24.5 per share on our short stock position because we had sold at $191. Thus, we would have had a total profit of $5,220, $4,900 from the shorted stock, and $320 from selling the puts, making a 13% return on investment in only 28 days. The advantage of buying the contracts at that time is that we end with the obligation to buy the shares. 4 days later, at options expiration, the stock closed at $161.82. That can be seen here. 4 days after March 14, at options expiration, the stock closed at $161.82. At that time, the puts with the strike price of $165 expired in the money, so the owner of the contracts would have exercised his right to sell at $165. So if we had not previously bought the contracts, we would be forced to buy the 200 shares at $165. Therefore, we would have made a profit of $26 per share on our short stock position because we had sold at $191. Thus, we would have had a total profit of $5,840, $5,200 from the shorted stock, and $640 from selling the puts, making a 15% return on investment in only 32 days. Although we had been making the maximum potential profit for this strategy, we would have lost the shares sold short. Here we can see the numbers of our example. The strategy consisted of selling 200 shares of Amazon at $191 and then, with the stock trading at $169, selling 2 puts with a strike price of $165 and expiration in March 2011 at $3.2. Therefore, our investment is equal to the $38,200 received for selling the shares plus the premium received for selling the puts. The premium received is equal to 3.2 multiplied by 100, which is the price of each contract, multiplied by 2, which is the number of contracts sold. That is $640. So our investment is $38,840. The initial margin required is equal to the 50% of the value of the short sale, that is $19,100. The puts sold are covered by the short shares. The maximum profit we can make is equal to the stock price at trade initiation, that is, at the time of put sale, minus the strike price, plus the premium received, multiplied by the number of shares. That is $1,440. In addition, at the time of the sale of the puts, we already had a profit of $4,400 from the short stock position. On the other hand, the maximum loss that we are exposed to is unlimited, because the increase in the stock price has no limit. The break-even point is equal to the stock price at trade initiation plus the premium received. In our case, $169 plus 3.2, which is equal to $172.2. Here we can see the order we must enter to open the short stock position. It consists of selling 200 shares of Amazon. In the side column, we select the action Sell to indicate the sale of shares, and in the Position Effect column, we select the option To Open to indicate that we want to open a new position. The entered price is $191, and the order type is Limit. Here we can see the order we must enter to open the short put position. It consists of selling 2 Amazon puts with a strike price of $165 and expiration in March 2011. In the side column, we select the action Sell to indicate the sale of options, and in the Position Effect column, we select the option To Open to indicate that we want to open a new position. The entered price is $3.2, and the order type is Limit. It is important to mention that in a covered put, when the orders to sell the shares and sell the puts are placed separately, that is, one order for the short stock position and another order for the short put position, single leg orders are used. In that case, we pay the brokerage commission for each transaction. On the other hand, here is an example of the order we must enter to close the short put position. It consists of buying the 2 Amazon puts that we had sold. In the side column, we select the action Buy to indicate the purchase of options, and in the Position Effect column, we select the option To Close to indicate that we want to close an existing position. Here is an example of the order we must enter to close the short stock position. It consists of buying the 200 shares of Amazon that we had sold short. In the side column, we select the action Buy to indicate the purchase of shares, and in the Position Effect column, we select the option to Close to indicate that we want to close an existing position. If we sell the shares and the put options at the same time, the order to open the position can be entered using an order with two legs. Here we see an example. Leg number 1 corresponds to the short put, that is, to the sale of the puts. Leg number 2 corresponds to the short stock, that is, to the sale of the shares. In this case, the entered price is given by the sum of the selling price of the options plus the selling price of the shares. For example, 3.2 plus 191, which is equal to $194.2. This is the money, expressed per share, that will be credited to our account when the order is filled. In a covered put, when the orders to sell the shares and sell the puts are placed simultaneously, that is, the same order for the short stock and short put positions, a multi-leg order is used. In that case, we only pay one brokerage commission. In the same way, the order to close the position can also be entered using an order with two legs. Here we can see an example. Leg number 1 consists of buying the puts we had sold, and leg number 2 consists of buying the shares we had sold short. In this case, the entered price is given by the sum of the purchase price of the options plus the purchase price of the shares. For example, 1.6 plus 166.5, which is equal to $168.1. This is the money, expressed per share, that will be debited from our account when the order is filled. Here we ended with the chapter Covered Put. In the next chapter, number 11, we will analyze in detail the bull call spread strategy.